Side. Oh, perfect.
Hey everyone, seeing some folks start trickling in. We'll definitely give people some time to get settled and to welcome in. It's not even noon yet, so nice to see that there's some people that are like us, early attendees. But we'll wait. I mean, it's I'm Fraser from the marketing department here at Boosted, and I'm based in Toronto, and gorgeous weather out there. So I'm very happy that people are willing to take their lunch hour and join us, chat with us. So thank you all very much for your time. Today we're here to talk about implementing AI for investment managers. Why now is such a critical turning point in the asset management and tech space, and probably a lot more importantly, and maybe why some of you are joining in, how you can actually go ahead and start using, making use of these data-rich insights that AI can provide. I'd like to introduce Jan van Arsdale, who's one of our managing directors here at Boosted. He's in sales. Jan is joining Boosted, or has joined Boosted, with a wealth of experience in equity capital markets, working on the buy side, electronic trading, equity research, and I'm sure plenty of other odd jobs along the way. And today, Jan's going to share with us why it's such an inflection point for AI and how investment managers can start seizing the opportunity themselves. I'll give just 1 or 2 more minutes here, and then we'll get Jan to kick it off here. I think Jan, whenever you're ready, we'll let you get started. Thank you so much, Jan.
All right. Well, Fraser, thank you so much for the introduction. And I think in college I had a few odd jobs, which I won't list, but I think they're on my LinkedIn page. But hey, my name is Jan van Arsdale, and I'm on the business development team here at Boosted.ai, coming to you live from our Flatiron, New York City office. The advent of ChatGPT has brought the question, what is AI and how can I use it? AI is already all around us and touches us every day, and it's being used by almost every industry, everything from retail to manufacturing and your favorite streaming service. The technology that Netflix uses to make interesting viewing recommendations, or that Waze uses to calculate a route to help you avoid traffic, or Tesla uses to self-drive cars. These are all offshoots of continuously learning artificial intelligence. You're probably seeing a lot of articles about generative AI, the technology behind ChatGPT. People are taking advantage of this tool for tasks as simple as composing an email to things as complex as organizing research for a thesis paper or writing Python tools. But what about AI in finance? And more specifically, what about AI and investment management? The excitement around understanding how to incorporate AI into the investment process has created a lot of momentum. Q1 was a record quarter for Boosted AI. We signed up more clients to our platform than in any other period in our history. Later, I will dive into what we're doing here at Boosted and how we have been helping investment managers integrate AI. But first, I want to look back at how I've seen the investment process evolve over my career and why now is a great time to be thinking about using AI tools. My first job in the securities industry was at a large buy-side investment manager in the early 1990s. At that time, fundamental managers viewed stock charts as something they didn't utilize. Measuring trade volume, pricing, and stochastics was seen as technical analysis and not something widely practiced. It was all about doing pure fundamental research. Today, 20 plus years later, not only are technical screens now an integral part of the fundamental investment process, stocks are now even measured for their short interest, crowding, momentum ownership, and many other key components. But that said, many traditional stock screening methods and the theorems around the risk premium between stocks and bonds are still practiced today, even though these rules can sometimes break, depending upon the macro regime. We saw this play out in 2022, when by mid-year, The S&P was down 21%, and the bond index was down 10%, breaking the rule that the fixed income market is a ballast from underperforming equities, and had investors questioning their traditional asset allocation strategies. While 2022 may have been a perfect storm with the Fed aggressively fighting inflation, these once-in-a-lifetime events seem to find a way of happening more frequently. So if rules sometimes break, there must be a way to take advantage of all of the patterns we've discovered historically around these events. Now, by the mid-1990s, I had joined a pioneer in the electronic trading industry. At that time, most investment managers would only trade stocks by calling a broker. However, by the early 2000s, given the massive adoption of electronic trading by the investment community, thanks in part to the boom in internet and technology stocks, not only was most trading done electronically, but a lot of it algorithmically, as machines handled the bulk of the orders. One view of a typical exchange trading floor in the mid-1990s versus today paints the picture of the massive efficiencies which technology has brought to the world of trading. Now, before joining Boosted, I spent the last 15 years selling equity research to investment managers across North America and Europe. During this time, I met a lot of very smart analysts and corporate management teams and discovered that despite all best intentions, there are biases. Human biases like emotional connections to companies and their management teams, which can sometimes create conflicts, whether it's a personal connection with a CEO or CFO or a good or bad stock call. Either of these can cloud our view. There's also corporate biases. The relationship between a company and a sell-side analyst can sometimes create unintentional biases, whether it's demand for future corporate access or investment banking opportunities. I'm reminded of Bed Bath Beyond a few years ago when they announced a new CEO, and many sell-side analysts view this positive catalyst as an inflection point. The reality is that the retailer was losing market share, and after filing for bankruptcy protection just this past weekend, they announced the closing of all their stores. Another reminder that there is no bias around analyzing pure data points. So what doesn't have a bias? A machine. So the question is how to use a machine to help protect against human biases when evaluating investment decisions. But before diving into this, let's look at the explosion of data and its adoption. One big observation I made early during my equity research tenure was that a select group of early adopter investment managers were taking advantage of new proprietary data sets to improve their fund performance. One of the best examples of this is credit card data, and the ability at that time for a small group of funds to take advantage of transaction data to make better decisions on which retail stocks to buy and which to sell to help set them apart from their peers. Once the success of a few became obvious, and given the importance for a fund to show good performance, especially versus its peers, the rest of the industry rapidly adopted these expensive sets. These types of data sets are referred to as alternative data. In 2019, a CNBC article estimated there were over 400 companies collecting alternative data and selling it to hedge funds, as more and more funds were seeking a way to get an edge. That 2019 article estimated the amount spent on alt data was around $1 billion. And this chart from Precedence Research is estimated to be $7 billion this year and will continue to grow significantly over the next few years, with an estimated CAGR of 55%. Alternative data makes up just part of the world of big data, which also encompasses traditional data like earnings, balance sheet, trade volume. So why is big data an important part of the conversation? Because a lot of what we can do today wasn't available until recently. Although the concept of cloud computing has been around since the 1990s, the advance of the technology in the 2000s helped it expand. Now we have the ability to collect and store huge amounts of data, which makes the analysis of this information an intricate part of everyday life. But this has only really been in practice for the last decade. The analysis of big data allows scientists and statisticians to dig deep, find new and meaningful insights used in multiple industries across our economy. Essentially, big data analysis helps businesses make better decisions while maximizing operations, reducing risk, and improving efficiency. In 2017, McKinsey published a study focused on the adoption of machine learning by big banks. Banks were using these tools to help understand and improve their internal process and overall profitability, including focusing on churn, profit margins, or analyzing customer data for potential new products. As pointed out in the article, the ability to analyze massive amounts of meaningful data has only been available within the last 10 years, as the size and cost of processors has decreased, along with an exponential increase in computing power. Simply said, the opportunity to take advantage of analyzing big data is a relatively new moment for the financial industry. So how can an investment manager take advantage of this opportunity? AI combined with big data helps sort and learn from the vast amounts of data in the world of capital markets. Analyst reports, balance sheets, earnings estimates, credit card data, the list goes on. A person could, with enough time and energy, analyze all of these sources to come up with interesting results. But what about the dynamic covariance between these data points and technical and macroeconomic indicators, or the ability to understand that some metrics can become more or less important over time, depending upon the regime? This is where the power of the human and the machine combined creates a much more dynamic and beneficial outcome. At Boosted AI, we believe the future of investment management is the combination of human intuition and the processing and adaptive power of AI. We have focused on making easy-to-use tools for investment managers to get immediate value out of the pairing of AI and their years of finance experience. Now, we've spoken to a lot of asset managers over the years, and we've learned that when it comes to how they interpret using AI, there are a few non-starters. First, AI has to be additive to their process, helping them perform unbiased research and bottoms-up analysis, mixing a blend of the most performative of fundamental, technical, and macroeconomic data. Second, AI has to be data-rich, covering developed and emerging markets, of course, but also other data parameters like tick data, short interest, options volatility, ESG, along with fundamental, technical, and macroeconomic data. And third, AI has to work their way, being able to ingest their own data sets, helping them isolate relevant patterns, especially those that are non-intuitive, to be sensitive to regime shifts, and most importantly, be applicable to their stock universe, with deep dives into any region, sector, or stock. We have built and fine-tuned the Boosted AI platform over the years to address all of these needs. Over our history, we have successfully introduced our machine learning tools to many global investment managers. But we realized it was important to make the insights from our AI-driven research even easier to interpret, understand, and surface to the end user, which of course makes it simpler to incorporate into your investment process. This led to the introduction of the newest version of our platform, Boosted 2.0. Beyond being able to dynamically rank a universe of stocks and predict alpha over a short or long time investment horizon, clients can now analyze our AI insights across their own custom watch list or holdings, understand which of their ideas are the most actionable and why, and analyze which traditional risk factors have contributed to their performance or underperformance. Now, before I show you how we can integrate AI into your process, let me talk about the Boosted AI Recommender. Boosted AI is able to analyze and compare the predicted stock ranking, which is the exhaustive bottoms-up analysis we do for every stock in your universe, with real-time variables like the accuracy of the signals in the current environment, the effectiveness of the signal in the current environment, and if a high, moderate, or low risk factor score will have a high statistical likelihood of outperforming or underperforming to help you determine actionability. We help you understand the risk reward and potential excess return opportunities for all of your stocks. So I'm going to switch over to a demo, so please hang on 1 second.
Thanks for walking us through so far, Jan. I just wanted to thank everybody else for joining. We're seeing some really interesting questions in the chat here, and so towards the end, we'll leave some time to discuss any questions that anyone has here, and feel free to keep adding them here in the Q&A, but I'll let Jan take it over again. Thanks very much.
Thanks a lot, Fraser. So we're looking at a live platform right now. And the first thing I want to start with is a watch list. So I put together a list here on the screen of some large cap stocks that I think are interesting. Got AutoZone, Colgate, Coinbase, Disney, Google, Kroger. Meta, which had a good day, obviously, Match, O'Reilly, et cetera. So a whole bunch of stocks here. But what I want to do now is think about right? I want to think about these stocks through my own perspective using metrics that I care about. So I'm going to go to the Boosted strategy library. And within this library, there is a large cap strategy, which actually is full of lots of fundamental metrics and just a few technical metrics called large cap main right here. So I'm going to click on this strategy right here. Here, I'm going to see a quick little preview of the performance. This blue line represents how well it's done in the back test. The yellow line is the live performance, and this black line is the benchmark, which is the Russell 1000. So this is the lens which I'm going to use to look at this list. And so now let me look at the watch list now that I've added my own strategy. So we use a rating of a 0 to 5 to look at all the stocks in our universe. And when we think about the top 20%, those stocks that we really want to focus on from a buy perspective, those are the stocks that get a rating of 4.0 and higher. Those are our top quantile, our top 20%. And when we think about the rest of the universe, some ratings may be lower, but we want to avoid those ratings usually below a 2.0 and especially a 1.0 and lower. And a 0 would be that lowest rating in our universe. So I can see here, like for instance, O'Reilly Automotive, we got a 5.0 rating. And then thinking about the boosted recommender, it's now looking at the market conditions, it's looking at the AI accuracy, it's looking at the factor scoring to come up with some conclusions about what it thinks. But what if I could add other strategies to my watch list to give me perspective on a short time horizon? Because my large cap value strategy is thinking over the next 12 months. What if I want to think more short term from a trading perspective? Or how about if I want to use a strategy that also is using much more of a technical momentum focus on top of fundamentals? So I've added 2 more strategies to my watch list. And now I have what's called this Russell 1000 strategic, 12 months, but more technical momentum, and a Russell 1000 tactical, which is shorter term in nature. The reason, because I have now 3 virtual analysts giving me their perspective for every stock, helping me get some consensus as I look across each of these different stocks. And I can see now that the top idea now is Hershey, followed by AutoZone and O'Reilly, based upon the consensus aggregation of the scores of each of these 3 strategies. But let's investigate why, for instance, O'Reilly Automotive. Why is this particular strategy, this Russell 1000 strategy, recommending O'Reilly as a strong buy? So now I can see the company name, the sector, the subsector, and I want to now think about a 1-year investment horizon for my stock. And here I see the rating, 4.6. Again, the exhaustive analysis we do, bottoms up, comparing O'Reilly versus every other stock in the Russell 1000 has yielded this 4.6 rating. But now let's think about the boosted recommender. Let's think about the things that are important when we're thinking about the potential opportunity. So for this particular stock, the machine has looked at its size factor score, the accuracy of how well we've done in making these selections, and determined that there's a high likelihood of an outperformance. In fact, it's predicting that it's going to outperform the benchmark, which is the Russell 1, by 3%, an average risk, high reward opportunity. And if I scroll down here, now I can see how well boosted is done from a rating perspective in actually looking at O'Reilly. So at this point in time, which was May 31st of 2022, the machine recommended O'Reilly as a strong buy. And so from this point in time to here, I can see how much better it's done versus its benchmark and continue to do well. So interestingly, this model's got a lot of consistency around its rating. We've had a buy rating for the stock for almost the last year, and the stock has done very well. But what if I want to think about O'Reilly and stocks that are similar to it, but not just that ones that are automotive retailers like CarMax, but let's think about stocks that are similar from a factor or data similarity perspective, because maybe if I own O'Reilly already, there are other stocks I should be thinking about. So we're going to give you a perspective of other selected companies, McDonald's, Dollar General, Walmart. How about thinking about why the machine has a 4.6 rating? Let's look at the drivers that we've identified, the fundamental scores, the technical scores, what's changed over the last 3 months. How is this stock relative to the rest of its group? So within consumer discretionary, we have a rating of 2.4 for the sector, but a 4.6 for the stock. And within automotive, it's done very well as additionally. But let's think about the performance attribution. How well is the stock done, and what can we attribute the performance to? Well, for the last 3 months, O'Reilly's up almost 13%. And I can scroll down and see all the different factors, but importantly, the stock-specific factor feature, idiosyncratic, is up 11%, which means the machine's done a good job picking the stock, and that's been a big reason for its outperformance. But it's also got a positive contribution from other factors as well. But I have other ways of drilling down and understanding O'Reilly and what else I can learn. Like for instance, what about if I want to compare O'Reilly versus the other 2 companies that were AI selected and understand how do they measure versus O'Reilly from a risk reward perspective? What are their inputs that the machine is seeing? And let's look at the data across all the other comparables. But what if I also want to say, let's go deeper into the similar securities? Boosted, can you help me understand all the stocks that are similar to O'Reilly from a factor or pricing similarity perspective? Because maybe I want to understand other stocks that may be very, very similar. Now we can look by rating. Again, a 4-star is a top 20% stock, and understand what are the stocks that are similar from a factor data similarity perspective, and what are similar from a pricing perspective, and what are combined the most similar stocks. But really, from my perspective, I want to do a fundamental dive into the drivers. I want to understand if the machine's got a 4.6 rating on O'Reilly, what is driving that rating? Well, let's dive into some of these fundamental features. Let's see, within quality, we have efficiency, leverage, and stability. Let's investigate our efficiency features. Operating cash flow to asset. Let's maintain a strong rating here. Return on invested capital, maintain a strong rating here as well. So this is a great example of how you can take a rating and you can take a recommendation, but then do your own research to understand exactly what is the machine identified, what is this particular AI analyst focusing on. Now let's go back to our watch list. This is really obviously a great way to consolidate, all the stocks you care about. But the thing about Boosted is, the point of seeing, using us as unbiased AI research is not to agree with your stock picks, but to give you conviction when it lines up with your decisions, but also to raise questions when it doesn't. For instance, let's look at a stock that our AI analyst views as out of favor. So I'm going to flip our ratings upside down. Let's look at Coinbase. So Coinbase has a 0.1 rating, and the machine's actually recommending it as a strong sell. Well, what is the machine seeing here? So the machine's actually suggesting with a 0.1 rating that not only is it going to underperform, but underperform by almost 6.5%, that the risk is very high and the reward is low. From an accuracy perspective, we've been pretty accurate. The value perspective, so the value factor score is low and the market conditions from the stock are extremely negative. Just looking at this chart just gives you one idea why you may want to avoid this stock. But imagine if this was a stock that maybe was on your watch list or one that you held. We are helping you at least understand that why it's out of favor and maybe a stock that you should be trimming or now you may be avoiding. So as we go back to our watch list, I'm thinking about all these stocks. It'd be really, really interesting as I'm thinking about new ideas, if I could actually look at a strategy that I like for instance, this large cap main strategy where I'm only thinking about mostly fundamental features, thinking more from a value perspective. What if I could have the machine look at this specific strategy and then recommend ideas to me where the recommender has noticed that there's these things line up really interestingly. So we have what's now available, our ideas feature. And so on my ideas page for that particular strategy, there are 2 stocks the machine is recommending. Timken Company, TKR, United Health Group, UNH. TKR with a 4.7 rating, UNH with a 4.8 rating. And here's the part that's really cool, I think. We've got this giant, incredibly big statistical database of lots of data points that tell us what could happen when certain things line up. Then we take advantage of natural language processing to convert that into text to tell you in real plain, easy to read language why the stock is being recommended, what we've indicated. So for UNH, we're looking for a strong trend continuation. Now, we also want to give you perspective. What stocks have moved them down the most in this particular universe? What have moved up the most? Or how about from a sector perspective? What's in favor? What's out of favor? Or within your universe, when the machine's looking and thinking about what it likes, is it looking at a certain specific metric and thinking that that's important? Like for instance, earnings before interest after taxes over the last 12 months, the machine's suggesting that a high score is a reason or an indication of a predicted buy or a buy opportunity. So this is a way for us to be able to do that. Now, let's say, for instance, I'm thinking about UNH, and I'm like, you know what? Potentially a new idea I want to add to my my portfolio. It'd be interesting to see how is UNH viewed across all the strategies on Boosted. And so let me just type in UNH and see. Well, let's just see how we use UNH lining up. Think about when you quote up a stock on, let's say, one of your quote systems, not to use the words starting with the letter B, and then you were to look and see all the analysts and what their recommendations were. Use us the same way. So I'm thinking about UNH, and across all of these strategies, there are a lot of buy and strong buy indications with high ratings, a few holds, no sells, no strong sells. So regardless of the strategy, whether it's short-term or long-term, regardless of whether the strategy was value, momentum, technical, I'm getting the impression that across all of these boosted strategies, UNH is a very interesting idea. So I'm going to go back to our deck for 1 second. So excuse me while I do that.
Thanks again for that walkthrough, Jan. It's been really interesting to kind of see how a person can slot AI into their process relatively easily. We've got some great CS folks that can help people along their way, but it's not as daunting as I think folks think, and I think that that's where we're looking to add value here, and we're doing so. So take it away again, Jan. Thank you.
Fraser, thanks. And those are actually great thoughts. I mean, the team here at Boosted is amazing. And all we want to do is really work in a kind of consultative type of way with you to help you integrate these tools. So how can you integrate Boosted AI as a research and screening tool? We asked our institutional clients how they have found the greatest success from using our tools. And across the board, it seems having a more systematic approach and being able to analyze every stock through an unbiased AI lens has been a big benefit. What we've discovered is that understanding when a position in your portfolio is either in or out of favor can be a big opportunity cost savings. Additionally, being able to screen for new stocks to add to your portfolio has been a big time saver. So is AI for investment management all hype or a real way to get actionable insights? We certainly think asset managers have a lot to gain by implementing AI. And while it is still very early innings, the rate of AI adoption by the global investment community has been amazing. We have onboarded or are in the process of onboarding institutional managers from nearly every continent. We've successfully figured out how to make a sophisticated tool easy to use and complementary to your investment process. While we work with several quantitative funds because our signals are quite good and very unique, fundamental managers who are seeking a way to make their process more systematic have found a solution in Boosted AI. When analyzing the adoption rate of alt data by the investment community and the potential for the early adopters to create a competitive moat versus their peers, it seems reasonable to me that you can make a similar comparison around the adoption of machine learning tools like Boosted. Let me summarize some of the benefits investment managers should expect from their AI solution. Number one, unbiased. An AI lens completely data-driven into your stocks that is unclouded by human bias. Second, efficiencies. One of the earlier statements around big data analytics is that it helps businesses make better decisions while maximizing operations, reducing risk, and improving efficiency. You should seek to improve your efficiencies in several ways, including your wallet, by helping you allocate your commission dollars to your partners more effectively, and time, leveraging your expertise to cover more stocks and devote more time to focus on the new ideas, the top new ideas. And lastly, alpha, by helping you screen your stocks more effectively and only focusing on the top ideas, your AI tool should be helping you drive alpha and avoid opportunity cost around holding positions too long or entering too early. Before I close, I'd like to talk about why I joined Boosted AI. Since I first joined the finance industry, I've been interested in the convergence of technology and how it can help investors. The best part of my job over the years has been the opportunity to connect with clients around new ideas. As more institutional investors strive to be independent from traditional sources, it's very exciting to be able to introduce a new source, a cutting-edge technology which can help them be better investors. Boosted AI has given me the opportunity to connect with investors all over the world and introduce them to what I think is an amazing tool. Thanks so much for participating. If you'd like to learn more about how AI can help your investment management process, use the QR code or email our Director of Business Development, Raina Cernick. And now let's answer your questions.
Awesome job. Thanks, Jan. It was really interesting to hear some of the ways that folks can be using AI immediately. I'm seeing one question now. It says, do you cover European markets? I think, Jan, you can, we've seen a lot of coverage, and so you take it away.
Sure. Yeah. So we are truly a global platform. As we have onboarded clients all around the world, we've onboarded new countries onto our platform. I'll just say we cover over 55,000 stocks. I remember when I first started, we had just onboarded a client who wanted the Jakarta exchange in Indonesia on the platform. So I would say we cover every developed market and many developing markets, if not most. So yes, we definitely cover Europe.
Thanks, Jan. Sorry to cut off with that. I think that we've got some great questions here. So let's get into some of the ones that folks have shared. Really appreciate everybody's participation, by the way. First one here is there any empirical evidence that machine learning or regression / classification algorithms related to asset allocation, stock selection, portfolio optimization, et cetera, have an edge over just traditional fundamental analysis or technical analysis?
That's a great question. And I think
Mouthful.
that, I'm sorry, it's a mouthful. Yeah.
Mouthful, I
Well, it's a
know.
mouthful and it's a great question. I think that there are definitely a lot of ways that we can talk about the empirical evidence. I mean, we have several live models. I mean, Boosted has been around since 2017, and we have major clients and we've been working with for a long time. And we have several live models in production since then where we can show how well we have done versus our relative benchmarks. But I think the way to think about this is what is unique about what we do and how we complement these other types of processes. Because I think that coming from a fundamental background myself, I appreciate the fact that it's important to be able to screen stocks, whether growth or value. But what we can do is help you understand that there's a changing dynamic between these metrics. And you simply can't just look at one set of metrics like fundamental without looking at technical or macroeconomic and understanding that there's a covariance and that they can change over time. So what I would say is that there's a more thoughtful way of being able to analyze this together, and we can help you really understand that there is a changing dynamic. And that as we go through a factor rotation, like from growth to value and back to growth again, that we're able to help you understand that as it's happening.
Great answer. Um, what about how AI can be used as a tool for highly active and concentrated equity funds?
Well, I mean, I think, for active funds in general, I think you're always constantly thinking about what you own and what you could own and potentially what maybe you should be trimming. And I think that we want to be a tool that allows you to do that. But I think that especially for those managers that are focusing on only owning, let's say 20 stocks, 10 stocks, they may think, well, how can you help me? Well, the bottom line is if you own 10 companies, you care about the comps for all 10 companies. Your watch list is probably 100 companies, and you need to know what's happening dynamically across each of them. And you want to understand the nuances from all of them and how they're interrelated. So what we do is allow you to look at your stocks and all the related stocks much more effectively in a much more unbiased way. So I think actually for the concentrated manager, they need us even more than the manager who has several stocks because we're helping you really understand the stocks you own better and the stocks you don't own and why they're maybe impacting the ones that you do own.
Great, great. I totally agree with you. I think next question here is a great one. It says, what areas of asset management can AI replace?
I love this question because it implies that there's something to be replaced when there's not. And I think that the slide earlier was the human and the machine. I mean, I think human intuition is an amazing thing. And I think what each of our clients brings to this process is their professional experience. And I don't think we would ever look at least in professional management, a human being replaced because of what we can do. But what can a machine do? It can process information in an exponential way and make patterns appear that we can't see. And so being able to use a machine along with a human to me is really the complement that really will make this the best outcome possible. So no, I don't think this will ever replace anyone, but I do think that those who don't adopt this technology will be left behind.
For sure. I mean, I think, in my research, I'm in the marketing team and I see a lot of things that herald the end of something, the rise of the machines, but everything that we've ever seen is that like it's very much the human is still in control. The investment advisor is the one that is leading the charge here. It's just like we're giving them all the tools to kind of help, right? So I think that that's a great one, Jen. Why are the ratings of some stocks on your watch list not consistent across your model strategies?
That's a good question. You may have seen when I flipped the chart upside down and we saw some of the lower ratings that depending upon the strategy, there may have been like a 3.0 rating on one and maybe a 1.2 rating on another. The reason is because each of the strategies has a different goal. So the strategy that I was looking at had a 12-month time horizon, but another strategy had a 1-month time horizon. So if I'm thinking about the next month, an idea that I might find very, very interesting may not be a great idea for the next 12 months. So sometimes when we're able to juxtapose a long-term horizon with a short-term horizon, we're able to get some interesting insight. Sometimes the model strategy can be completely driven by momentum and technical features, which is interesting when you care about those types of names. But if I'm purely being driven by fundamental metrics, then the ratings I'm getting from that particular strategy are more relevant to me. So the fact is that we want to have a strategy library that's available to everyone to use, but to give everyone the perspective of being able to be a value investor, a growth investor, to be a sector-based investor like healthcare, energy, or to be able to think more of a global type of model. Any of those are available, but everyone is obviously has a different perspective. But when we line them up together, each one is a virtual AI analyst, which may have a simply different, unique view and a different goal to solve for, which may give a sort of a different blend, which is why at the top of my list, I saw Hershey, which obviously had a strong rating across all three strategies, which gave me a lot of conviction that Hershey was probably a very interesting stock on top of making great chocolate bars.
Up here in Canada, I think we've got a few different ones, and they're much sugarier, but
All right.
still good. Another question we've got here is a person saying, "Who do you see as your competition?" Which is obviously a pretty fraught question, but
Yeah,
we'll
no, it's
you know,
it it's a great question. I know Gartner has that magic square where you put like, sort of like where everyone lines up in different areas. And I think as we view the landscape, there are some really cool companies out there that do a lot of good risk analysis, and there's some cool companies that maybe are also tapping into ML tools. I don't really, and we haven't seen anyone that is able to take our view of being able to take very sophisticated tools and make them very easy to use, but also be thinking about lots of different components. But I think as some of the slides kind of illustrated, my impression is the competition really isn't versus other technology companies. It's versus old methodologies. It's versus old traditional thinking. It's about being able to adopt and embrace new ways of thinking. It's kind of like when I was back in the 90s at a pioneer without mentioning their name. It was either you traded calling someone up using a phone, or you actually then had a computer screen where you can actually see dynamically all the quotes. It took enough investors to realize that they were missing several basis points of performance by not being able to actually interact directly in trading, for them to realize I need to adopt this technology. I'm losing to my competitors. My perspective is the competition isn't really another technology company, it's an old methodology. And I think the more investors are able to embrace that they can use our technology to complement what they're doing, I think the quicker they're going to be able to really embrace that, they're going to be able to employ a new lens over their process.
sure. I'm seeing a few questions about just the strategies overall, so I'll kind of maybe lump them together into one. But one is, can you customize strategies? And then the second one is kind of within those customizations, are there how many different types of metrics can one use within a customization?
That's a great question. So I probably should start off with saying, clients can engage with Boosted in two ways. The first way is in a consultative way. We can work with you to help you build a strategy that replicates your investment process. We can understand all the screening metrics that you care about. We can understand the universe of stocks you care about, and we can tailor it specifically to your needs and spend a lot of time helping you find the right strategy that really replicates your process. But we also want to give clients access to a library of strategies which we've created, which could be ready for them right off the start, not necessarily explicitly designed for them, but designed for a growth investor, or designed for a value investor, or designed for a momentum investor, or for a global investor. So my impression is that clients can really think about it from one of two ways. Now, your second part of that question was about the number of metrics available. We have over 5,000 data points, and we have, I think as I've listed, I mean, over 6 different major data providers that we work with, giving us thousands of different data points that clients can use. So as you're building a model, you can take advantage of all these different metrics, or you can access our library, of which we've already taken advantage of all these different metrics. I don't know if I answered the question, Fraser.
No, I think that's exactly it. I mean, I think one of the follow-ups is kind of more about like top down versus bottom up versus different styles of data points. But I think, you had mentioned earlier the ESG, some of these other ones, maybe you can kind of touch on all the different types of sets within the strategies.
Yeah, sure. I think for fundamental data, we take advantage of our partnership with FactSet and with S&P Global Cap IQ. We've got our own technical database that's very rich, but we also have a great partner providing us short interest, margin interest, crowding from S3 partners. You mentioned ESG. We've got an aggregator called Owl Analytics, which is fantastic because they give us the best insight from all the various providers out there for that type of data. We use our macroeconomic data from the St. Louis Federal Reserve. And we have options volatility data from ORATS. So all of these providers together allow us to be able to do very, very interesting analyses and very, very performant studies around these different strategies.
Absolutely. Thank you so much for that. Um, Sorry, I'm just reading this one as we go. It says it's asking about how you kind of like make sure that the predictions are accurate over time. And I think that maybe kind of goes back a little bit to that one piece of the demo you had shown where it is showing the AI accuracy. Maybe you can kind of just expand a little bit on the accuracy piece a little bit.
Yeah, I think that the whole evolution of Boosted 2.0 is a really, really exciting thing, because if you think about the fundamental investor that does all of their work, they'll write their model, they'll do a balance sheet, they'll look at all the different inputs there. Maybe they'll meet with management, they'll speak to an analyst that covers the stock, they'll do all this homework. But then we get to the live environment, and what's happening, right? I mean, is the environment changed? Is there, are we going through a factor rotation? All these different things happen that can impact all the work you've already done. So part of Boosted 2.0 that's really, really exciting is the fact that not only can we think about how well we've done in terms of all the work from the stock rating perspective, but being able to look at the factor scoring and being able to look at the market conditions, those are all great. But being able to actually measure ourselves on how accurate our AI predictions have been to help give us conviction when we're actually making a recommendation, to me, that's a really big deal. So when you see that the machine is saying this is a strong buy, and we're saying that our AI accuracy has actually been very, very good, and we're giving you a time period there. Now, of course, you can go to the model and look at the back test and see how well it's done. You can see how well it's done in the live environment. But if we're able to look at all of those inputs and then give you a very, very qualified, I think, response as to what's backing up that recommendation, I think that gives hopefully a lot of conviction as well.
For sure. Another question here is which provider do you use for the short interest and the margin data?
Yeah, that's S3 Partners. And actually, if anyone's interested, one of my colleagues, Porter Fraker, did an excellent. We have a product, our hedge basket product, and S3 Partners has been very helpful for us. For anyone interested, that you're able to take any position where, for whatever reason, you can't sell, or you have a position that's long and you're exposed and there's a risk. If you want to create a basket to offset that risk, we have what's called our sophisticated boosted hedge basket product. And Porter hosted an awesome webinar talking about how we were able to use S3's data to help us with that. And so I recommend, if anyone's interested, just hit us over that email or QR code, and we can send you a link to that webinar because it was really good.
Yeah, and shout out to S3. We've also got, I believe, one, possibly more white papers with them as well. So there's lots of great data there. We're coming up at 12:45, and I want to be mindful of folks' time in terms of maybe running out to grab a little bite before their next meeting at 1 o'clock. So I think I'll call it there. But I just want to really thank everybody for joining, and especially thank Jan for walking us through um, what he's done here. I think it's really exciting how folks are able to use AI. Probably seems daunting, but I think that there's a lot of ways that folks can use it. So Thank you so much, Jan.
Yeah, and I just want to say, first of all, thank you to all our clients. Thank you for being an early adopter. Thank you for embracing this technology. And to everyone who's tuned in today, who's not, this is a great time to speak to us. And I really encourage you to start a conversation with us. Thanks so much for joining.
Hit that QR code. Thanks, everybody, and I hope you all have a great afternoon.
Take
Bye-bye.
care.